Markets took a beating to kick off the week with the S&P down over 2.4%, the Dow off more than 900 points, and the Nasdaq sliding 2.6% as tech led the decline as you would expect. The Russell 2000 fell sharply as well, confirming widespread risk-off sentiment. The pressure came as Treasury yields climbed, signaling continued hawkish expectations from the Fed, even as political tension escalated with renewed attacks on the Fed chair. Meanwhile, the U.S. dollar weakened. Gold surged to new highs. Interestingly enough, Bitcoin rallied past $87,000, pointing to strong flows into alternative assets out of your traditional U.S. assets. Technically, we're seeing key support levels break down on a short-term basis, an intraday type basis, momentum turning decisively bearish. In this episode, we'll break down where buyers might step back in or if we should brace for more downside. I'll walk you through the market internals. We'll look at intermarket clues, sector rotation, and a trade idea that aligned with this increased, take advantage of this increased volatility that we've had. If you're trying to navigate this shifting macro landscape, I heard today on TV, a technical analysis doesn't matter right now. Well, yes, it does matter. As you've seen in all the rest of all of our other videos, we've kind of had an idea of how this has been going, and that's been the case here so far today. So this breakdown, these videos really help you separate the noise from the actual signals that we can recognize. So let's go ahead and get started. Today is Monday, April 21st, 2025. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us on our blog, you can sign up for our free email up here at the top, either by clicking on subscribe free or just fill this in down here on the side. This is our Market Outlook live video. If you click on this image, it takes you to where we discuss all the old Market Outlook trades, see whether we should stay in them or get out of them. We also put on today's trade already before the market closes. Click on this bell down here. This will notify you when these posts on your computer here, when the new posts come on. Click this heart, it opens up a new tab. Hit that like button, like today's Market Outlook tweet. Same thing, click this thumbs up icon. It opens up another new tab. Hit that like button there as well. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. And those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and take a look at the S&P 500 with the market forecast indicators. You can see we dropped 2.3%, but we didn't fall. It came off the lows of the day at the very end of the day, so that's actually a good sign. That kept the momentum line from getting down to extreme lows, which is where we were at the lows of the day. It kept the near-term line from dropping below the 20th percentile, which again is where we were at when we were at the lows of the day. So that it could have been a lot worse than this. But it wasn't. This is actually not a bad, I mean, obviously it's a big down day, but you can see the range today was still below average, right? So it really wasn't that much of a down day. I know there's a lot of hand-wringing over it. You can see if I look at the close, 52.82, and the high at 52.32, even if you add another 50 points, you're barely, for the gap, you're barely above the average, barely. And that average has been coming down pretty sharply because of these last couple of days, last 3 or 4 days or so. Because you can see the range previously was actually a lot higher than that. It was up here around 20 points for SPY, so SPX would have been around 200 points. So again, it's about an average day considering the average volatility that we've had lately. So we have to kind of keep it in context. Like a 2.3% down day. We talked about this last week when we had the other 2% down day. Like that would have been a big drop during this period over here. But here lately, that's not really that big of a drop compared to especially compared to some of the gaps we've had to the downside lately. Very significant 3% plus gaps to the downside. So it did produce, so last week with our Market Scholars classes, we talked about the expectation, we talked about the expectation that we would produce a near-term decline, that the next near-term move is a near-term decline, and that we expected, coming off of this green tag, we expected a a new red tag to come down here. Again, sooner rather than later, either before or right after options expiration. Well, we got it, right after options expiration. Now we have a red tag. So that green tag is stuck. Since we have a red tag, this one's stuck now at 9.5%, and we're down here. So, and we talked about this is the best case scenario. Getting down to this 23% Fibonacci level of the decline, and getting down to the 38% Fibonacci level of this previous rally that we had, right? That would, and getting just a 5% tag, that's our best case scenario. That's we expected a retest of this low, and this is the best case scenario we discussed last week. The worst case scenario is coming down into this area again, 48.50, maybe even a little bit lower, down towards where the 200-week moving average is. That's our worst case scenario. So as of right now, I expect the best case until I see otherwise. Right? We anticipated a 5% drop like this, and we've got it. And now we'll see what ends up happening going forward from here. But again, the close gives us a very, very good. And again, it could have been a lot worse. The short-term sentiment could have been a lot worse. But now, we are set up for a bullish near-term low point to come out of, because it would be a higher low compared to the last near-term low, and the near-term line would avoid getting into the reversal zone, which also makes it bullish. So now we're coming off a bearish peak, and we cross below the intermediate line, but the intermediate line is actually still above market sentiment. So we get a good bullish bounce off of this near-term low, and now we got an opportunity to make some headway here to the upside. So if you look at the Nasdaq 100, we see very similar, right? The very similar pattern. Momentum lines oversold, but not extreme. The near-term lines in bearish territory, but not oversold. And the intermediate lines pulled down. It's below the 50th percentile, but it's still above market sentiment. So not nearly as bearish as what we could. Of course, the Dow Jones Industrial Average, had a really down day on Friday because of United Health. So it had a little bit more bearish of a short-term sentiment. Already had more bearish short-term sentiment going into today, so it has both lines below the 20th percentile. Not too extreme, however, so not too bad. And again, the intermediate line, despite its decline, is actually still above its market sentiment line as well. So that's, we're still okay there. The Russell 2000, you can see it also is a lot closer to testing the lows that we've had than the S&P and the Nasdaq. The Russell 2000 is a little different. The near-term line is not crossed below the intermediate line. The intermediate line is actually still in bearish territory, but it is above its market sentiment line. And your momentum line again did not fall too far there, and we're a little bit further up from testing. Remember, the Russell's been a lot more bearish, so it would have a better margin of safety right now than some of these other large cap indexes, considering again that we've been a lot further below that 30-week moving average than the S&P has, when we have just kind of barely gotten below the 30-week moving average there. Let's take a look at the other weekly chart that we have here, and you can see again the death cross. You can see we talked about that transition candle last week, how it was not a reversal candle because the Hakinyashi candle wasn't strongly bullish. And so here we go. We're back to getting a bearish candle. It's a lower close and it's a lower low than what we had last week, even if it's not quite lower on a closing basis than what we saw 2 weeks ago. The PPO still falling down, still negative. The size of the candle still relatively bearish. One of your more bearish candles that we'll see during a typical intermediate decline. Right now, if we take a look at the 3 green arrow chart, you'll notice again we have 2 red arrows. The Dow is giving us 3 red arrows. We just don't have the MACD red arrow yet in the S&P and the Nasdaq. We are pretty darn close. You can see the Russell 2000 is a little bit further away. Its stochastic actually is not red yet, like the others that we see there. And let's take a look at the 2-line version of these charts, and you can see breaking back down below that 8-day moving average. And we talked Thursday about breaking back down. We continued into that. We held it on Friday and then broke down a little bit more here today. You can see the MACD is down. It's not quite below its average yet. It's going to go down a little bit. It's not going to go down to lower lows. It's not going to go down to equal lows, I don't think. So stochastics is down, but still right around the midpoint. So we are below the value area still. There's still a lot of resistance above us. So it's not it's not going to be easy for any kind of rebound here. If I take a look at some of these other oscillators like the DMI, you can see again we're back above 30 in the negative indicator, still well below 20 on the positive. I told you when we got to this 25 line, a lot of times it bounces right off of that, and obviously it did. The RSI and the CCI, you can see we're still back to bearish levels here, so this can just keep going into today. And then again, we're still bearish on the weekly CCI, still below minus 100. You have to get above positive 100 to turn it green again. So that's, we're nowhere near that. We have to, we did get above positive 100 briefly over here, but it's got to, it's got to get above more than just positive 100 on a daily chart for the weekly chart to make that bullish run. So still showing bearish patterns there. If you look at the RSI and the CCI, again, you can see what's going here. Let me get rid of this. You can see that, oh, excuse me, sorry. Let's look at the Ichimoku cloud. We're still below the cloud, is what I meant to say. Still have a very mature bearish trend. The rate of change is still strongly negative, and we're still, the cloud's still pink. We're nowhere near getting close to the cloud there. I do think we will eventually. I don't think the rate of change is going to get below these lows, which means 26 days from here that we're down here. I don't think that's the case. Now, I think we'll, I talked about retesting, and we are in the process of retesting. We got the best case scenario right now for that retest. Again, strong, mature, bearish trend. Still back below the green line after being above the blue line temporarily, back below the 9-day midpoint of the 9-day range. If I look at the Bollinger Bands and the Keltner channels, again, you can see, I told you there's a big range between the Keltner channels and the Bollinger Bands. You can see the bandwidth is really high. The momentum is turning south again down there in the bottom right. We are slightly in the lowest quartile, but it really puts that lower Keltner channel. So I don't think we're necessarily done yet. I think we're going to retest that Keltner channel, barely, but I think we'll retest that Keltner channel. Hopefully sooner rather than later, because the more we wait, the more it's going to be down towards these lows. So I do think that's still a possibility, because that usually happens when the gap is so wide. I will say this though, on the other hand, that today I would say that's a common gap, and so we're probably going to end up filling in that gap sooner rather than later. I expect that we will fill in that gap sooner rather than later. We did gap down. We got a lower high and a lower low. We gapped below yesterday's low. We gapped below last week's low, and that's where we opened. It was a little bit of a runaway there, but again, we're not, we didn't have a bullish intermediate run. So runaway gaps occur when you've had a bullish intermediate run, and now you're reversing that. In this case, it would be a bullish intermediate run and reversing it to the downside. And obviously, this was not a bullish intermediate run. So that's why I think that's a common gap more than anything. We are still in the lower half of the range. We got up close to getting in the bullish territory. We did briefly get in the bullish territory on 2 Wednesdays ago, but we are back into bearish territory in terms of where we're at relative to the 4-week range, highs and lows, and we're back below the 20-day average of this blue line. So again, relatively bearish, not strongly bearish, but relatively, again, considering the context here, but still bearish, still pointing in that downward direction. Obviously, if you look at today's rate of change, or today's ATR range, I told you was a little bit above the average when you account for the gap to the downside. The volume is a little bit below the average, so it's actually not a bad thing. We are still pretty high on this normalized ATR, well above the 3% level, well above the 2% level, which is where we typically peak when we are on intermediate declines. You can see the volume appears to be also forming a top. Again, 69 million shares is way down here. So those are actually both good signs. And the other good sign too that we had today is the VIX didn't really go up very much. Obviously went up 14%, but again, put that in context with some of the other recent moves that we've had. You can see that's not that big of a move. I mean, the other 2% move was really not that big of a move last week. But this one still wasn't really that big of a move. Again, put in context. Now, it would have been back over in here or even back here last year around this time. But like right now, that's not even with a 10% gap up to the upside. It's still, that's still not the biggest gap that we've seen. So when you look at all from that perspective, we're still above 100%, but we're above 105, but we're not really too strongly higher. We're not even close to the recent highs. The VVIX is up above 110 still, but again, well off of its highs. So we still are susceptible until we break back down below that 110 level. We're still susceptible to these kind of bigger downside moves. So I think there still is a little bit more left to this near-term decline. We could still go up tomorrow a little bit, maybe even fill in that gap some, but still end up on the same near-term decline. So I think we'll still probably be kind of figuring out how big this red tag is going to be, whether or not it ends up here again. That's the best case scenario, is that it ends up here, right again on that 23% Fibonacci retracement. That's our best case scenario here, but I think we're probably going to end up coming down into this. We already did on an intraday basis this morning. I think we'll retest those lows and retest these lows too. Probably end up closer to a double-digit red tag before we end up with a really strong green tag coming off of it. So, I think a lot of times corrections have multiple legs to them. I think this is a multi-leg correction. This was our first leg. It did not get all the way to the 200-week moving average. We had a green tag coming off of it, which happens. It happened in our last correction. Before we ultimately finish the correction, which would be stage 3 of this decline that we've talked about before. And so I think we're still in stage 3. I don't think we're bouncing off the correction low. I think we're again retesting these lows, but obviously a lot slower with a lot less volatility than when we did the first time. All right, now let's take a look at what's driving this price action today. Look at this 25% move on gold. just to kind of give you an idea here. Again, like we've talked about this before too. Like we've had these kind of moves before on GLD. If I were to go back, let's go out to that 3-month return. So we'll go out to a 63-day rate of change. Bear with me 1 second. We go 63 days there. Again, you can see that 25% return. Let me zoom out. In the last 5 years, you can see we haven't had that kind of return. And you can see the last time we had was in August. We were up to a 24.8% return during the credit crisis in 2011. Coming out of the 2009 bear market bear market low point there in November, we had a 25%, just over 25%. Of course, right before the last time where every single U.S. asset went down, except for gold, was there in 2008, 2009. You can see gold also had a run over 30% in a month. But that was coming off of a low point of 22% that we had at the the very worst stages of the great financial crisis. And you can see some other instances there in 20 years. Again, back over here in 2006, when the housing bubble was right on the cusp, when the Fed was done raising rates, we were at 26.4%. So we've had these kind of moves before, but needless to say, we're not coming off of a major low point, similar to what we saw over there. We're not coming off a major low point this time. We haven't had a 3-month rate of change to the downside for a long time, outside of a few percentage points there. So big time parabolic move, and you see that as well in the DMI. When you look at the DMI here, again, you have to account for the gaps on this, but we did get a cluster last week. We have gapping up here today. We're above 50 on the positive indicator. We're way below 20 now on the negative indicator. So that ADX is really starting to rise in a big way. Again, we have to go back to last year when we had a similar rise in the ADX or in the positive indicator, and you can see eventually the ADX got up above 60 on that run that we had. So big run to the upside here. Again, the weekly version of this, you can see, is still so extreme, and its ADX is pretty high. Even the monthly version, You can see the ADX is above 50 on the monthly version here, and the positive indicator is higher than what we've seen in the last 20 years for this particular ETF. If I were to go back out as far as possible, here let's change it to GC so we can look at it as much as we can. Again, you can see we had really good run from pretty much the end of the bear market the tech bubble bear market, kind of the end stages of it. We still had another year there, but we had a big run up to 2011 in gold, and that pushed the ADX up, and you can see that it's that was the last time the ADX has been this bullish. We also had a big run in the late 70s and the early 80s. It also pushed the monthly ADX. You can see the negative indicator is lower than what we've seen in a very long time. So needless to say, gold is definitely going parabolic. Needless to say, that's pretty obvious observation. Again, getting that daily cluster, being 10% above the moving average, coming off that bull tag twice now, getting a bull tag and jumping off of that bull tag there. The other things that we're seeing besides those two is a drop in the dollar and the drop in bonds. So here, let's go back to this. Let's just go look at today. So let's go to April 21st. And you can see, all the equities, especially U.S. equities, and as well as real estate, down. Developed markets and emerging markets actually finished today flat. Developed markets were down about 0.5%. Commodities were down. The dollar was down, and bonds were down. So you had all these U.S. equities, including real estate, U.S. assets, all down. In fact, the only ones that weren't down was high yield. Interestingly enough, high yield outperforming long-term treasuries there, but that's really the main story of the day. You can see, if I were to take a look here at the TNX and how it's doing, a big move back up today. But remember, it had been down, had a run to the downside last week down to the moving average, back up to 4.4%. Remember, the Fed funds range is at 4.25% to 4.5%. So we're at the top of that range. A strong move to the upside on the market forecast chart here. Let's get on this chart here. Strong move to the upside on the short-term sentiment. The near-term line rising up above the intermediate line, crossing 40 and 60 at the same time. But I don't think there's a whole lot of upside to yields unless we break that 4.5% mark, which now would not only take rate cuts off the table, but would start looking at rate hikes later in the year if it were to persist above 4. I think that's a very low probability scenario, and that's why I think there's going to be a pretty strong ceiling here as a result of that. And then finally, I also mentioned the dollar. Let's take a look at the dollar here. And look how, it's as much as gold's going parabolic to the upside, the dollar is going parabolic here to the downside. You can see it's getting a weekly cluster now. Hasn't had a weekly cluster for a while, not since 2023. And you can see all the times before that. We are way below the moving average. We are further below the moving average than we've been in the last 20 years. So big drop in the dollar, breaking 100. Again, we've talked before too about we've been lower. We've been down to 90 before. And if I were to go out even further in time, we've been down to 80 before. So it's not like, as big of a downside move that we've had, it's not like we are extremely low. Like, way, back over here and, during the credit crisis, the last time gold was making a big run to the upside, the dollar was like 75. So now it's barely crossing below 100. So much different scenario now. But again, you can see how low we are below the moving average. And, that typically starts to set a low point, at least an intermediate low point where we get a run up to the upside here. We also mentioned commodities. Let's take a look at the commodity index. It was down. The commodities were down today too. They had a really good run up here lately, coming off that engulfing pattern. Tried to get above the 17-day moving average last Friday. We're back down below it, so we're still below the value area. So we're not quite out of the woods yet. There's crude oil. You can see the move it had today, again below its value area. So there's not a whole lot of upside to commodities either if economic growth expectations are starting to wane. And you can see commodities and when you look at the crude oil in particular has been below its 200-week moving average for a long time. So it's been in its own kind of bear market. My definition of bear market is not simply a 20% decline, but it's an extended run below that 200-week moving average, and that's what crude oil has been doing. So it reflects kind of an underlying concern about the strength of the economy right now, because strong economies, growing economies, need commodities to fuel them, and we're just not seeing that represented there. If you look at the sector moves and look at what it's done today, not surprising to see technology and discretionary down near their lows of the past 3 months. Let's go to just today alone here. And you can see they had the biggest down. I mean, they were down 4%. Now, everything rallied, but staples were down, utilities were down, real estate was down. Like, everything was down today, 3% or more. I mean, materials held up okay, but still, was down 2.5% almost at the lows. Staples were down 2% at their lows. Ended up only down about 1%. Materials 1.5%, but everything else was down 2 to 2.5%. So pretty broad selling. Energy was down there with technology and discretionary. Utilities are down there. So, we're still continuing to see. Let's see here. When did this whole thing start? We're still continuing to see. So starting on February the 20th. Let me bring this up here. Starting on February the 20th here is when this whole thing started. We'll go out to a 30-minute chart. Again, discretionary technology, the biggest loser, is down 22%. I mentioned energy has been, was an outperformer up until about April the 2nd. And from that point forward, energy has been an underperformer. Now it's barely outperforming the market, was underperforming the market for a good chunk last week. And you can see your safety trades, as bad as they've been today, right, with utilities and real estate kind of joining the party, they're still outperforming. They're down 5-6%, but still way outperforming what we're seeing in energy and discretionary. So we're still getting a pretty clear rotation here into the safety trades. This is the weekly chart. There's real estate, healthcare, utilities, staples, all strongly bullish there. Energy is that's actually materials there. There's energy. They're moving up to the right. Financials, industrials moving up to the right. But then you can see like technology, discretionary, communication services all moving down to the left, and that's again not the rotation we want to see. That's on a weekly chart. This is a daily chart, and you can see energy just really getting hammered here on the daily chart. Staples had been so strongly bullish, they're pulling it down a little bit, as with utilities. Technology moving up to the right a little bit there, but again, it's some wide, some strong bullish moves, but not. I don't see technology right now like giving us a lift here. If you look at it, technology relative to the rest of the market still very bearish, even though you're getting some momentum, some positive momentum despite the last couple of down days. You look at technology, here's the Qs relative to IWM, and what's interesting here is we still haven't broken through those moving averages on an intermediate basis, which typically we do when we're having some kind of, especially a correction. Here is XLK relative to the rest of the broader market, being below its 200-day moving average. Let me zoom out so we can get some context on that move. You can see how it's getting more bearish. Again, that's not typical. Like, we were holding up okay for a good chunk of the end of last year, but we finally kind of hit the tipping point. It's a correlation. It's a ratio that's strongly positively correlated typically with the S&P. Has returned back to that correlation as we've really gone south. But the nice thing is, from a long-term perspective, like, we've had some bearish momentum. We might kind of be bottoming out here. This is about as low as we got on the MACD at the worst of it. in 2022, and you can see the ADX is just actually rising above 20. So we might be, you know, now granted we can still go pretty low if we're going to retest those lows from the end of 2022 eventually. But at least for now, it seems like we have, you know, we've expended the most energy to the downside. And even though we might be retesting lows, you know, it doesn't have the same energy, the same strength. You know, the breadth is still not nearly as bad here. Let's take a look at the breadth on this chart. So let's look at the number of stocks above the 50-day moving average. Back below 100, but still, you know, again, off of its lows. Number of stocks above their 200-day moving average, still above 100 there, you know, well off of their lows, even though we're still below the average. The number of stocks forming new lows is still pretty low. Like, we're not back above that 4% mark yet, so it's not too bad. So, you know, if I look at the McClellan oscillator, which is another thing we like to look at to measure the breadth, again, it wasn't too bad yet today either. So again, we talked about the potential for a retest. We're getting it. We said that the retest would be a lot more controlled, a lot more orderly on a relative basis than what we saw during this first initial leg of the correction. That's happening. You know, we're at the stage right now where the best case scenario where we'd be kind of done with that. I don't think that we're necessarily done. I think there's still some more near-term downside to the market. So I think we'll probably end up retesting this 5,000 plus or minus a little bit again as we approach, you know, approach getting to, you know, the end stage of a correction, of any correction, which ultimately ends up typically being around that 200-week moving average, which you can see for SPX is trading right around 4,700 right now. So, you know, it kind of gives you an idea. It's a little bit below, so we might end up just kind of getting to 4,800, which is the old pre-correction highs from 2021. Let's take a look at our trade idea of the day. We'll start off taking a look at eBay. So let's pull this. Remember, we already put this trade on during the Market Outlook Live earlier before the market closed. You can see eBay has been kind of in this sideways action. It's been, you know, we got dark green shading because the intermediate line's rising above 50, but it's still in between 50 and 60. In fact, the near-term line we're above a falling moving average. If you look at the weekly candle, it's a really small kind of neutral doji type candle. If I can get my cursor, there we go. You can see kind of a neutral candle there, red arrow, so we're below the 10-week moving average, but we're still, you know, got, you know, a PPO is positive, so we're still in a golden cross environment. If you look at the 3 green arrow chart for eBay, you can see, you know, we got 3 green arrows, but we're kind of going sideways. The MACD histogram starting to roll over there. If you look at the 2-line version of this chart, you can see that we're right at the point of control. Pretty much the 50, 30, 8, and 17-day moving averages are all crossing through today's range. You know, we've been converging on the 200-day moving average here for a while now. If you look at the DMI, you can see both lines are below 20, so very neutral in that regard. Looking at the RSI and the CCI, they're both at neutral levels as well, right at the midpoints of their charts. If you look at the Ichimoku cloud, we are below the cloud, but we're above both the 9 and 26-day midpoints, a range midpoints. No trend right now. We had a bullish trend, it's gone. And then finally looking at the Bollinger Bands and the Keltner channels, the bandwidth, which is relatively high, has been moving lower, and we're right in the middle of this declining bandwidth. The momentum is getting close to being right there at 0. So what we decided to do was do an iron condor trades. So we sold the 25 delta here, sold the 25 delta over here, which we're closer to 26, and then bought 2 strikes away on both sides. You can see from a risk profile standpoint, let's set this slice as a break even, and you can see we position size. We get a pretty decent reward for about 2/3 our normal risk because of earnings that we have coming up here. But if I put those slices onto the chart, you can see my break evens here. It looks like it only did the 1, so let's add 1 because it's not putting this break even over here on, so it's right there. And then now let's set that slice to the chart. You can see the break even the entire bandwidth is inside of the break evens. We're sitting with the point of control and the biggest volume node in the past year centered right in the middle of it. So I really like this setup here for a neutral trade going into this earnings announcement. All right, well, that does it for today. You've heard from me now. Now, and hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else that's around. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody. We'll see you all tomorrow.